So this is a statement of what? Cash flow. Cash flow is IAS 7. Okay, the question, I'm trying to retrieve the questions.
The one that you had to do yesterday.
No, the one, yes, the one I told you do yesterday. It was
November 2019, question 5C.
I should get my soft copy first checkers.
Oh.
So the question takes the following are the statement of financial position of Pwani Limited as that 1st September 2017 and that 1st December 2018. So we have the statement for 2018 and 2017. Then additional information say Pwani. Additional information number 1 say Pwani Limited profit after tax for the year ended at 1st March 2018 was 21,80,000. The property, plant, and equipment in the books of Pwani Limited as of 1st January 2018 had been acquired at the cost of 7290. Then the company's depreciation is to be depreciated all assets at the rate of what? 10% per annum on the straight line basis from the date of purchase to the date of sales. On 1st September 2018, Pwani Limited sold an item of plant which at a net book value at the date of the sales of what? 520. This item of plant had originally cost 800,000 and the company made a loss of 20,000 on the sales of this item of plant. The company's finance costs and income expenses for the year ended that 1st December 2018 amount to 48,000 and 63,000 respectively. You are required to prepare the statement of cash flow for the year ended that 1st December 2018. We said the first thing is to what? Prepare the format. So this is the question is it is May 2019.
I'm trying to look the question here.
May 2019, question 2.
Was it May or November?
May 2019, question 2.
Oh. Okay.
Okay, so we start with the format that is Pwani Limited statement. Sileo masikio itaisha. Statement of cash flow.
Inakuumiza. Let me join with my computer because I think he is seeing in a letter sheet. Let me join with this computer, then we continue.
The year ended for the year ended that 1st December 2018. So we said we need to write the format first. To say we start with the profit before
tax.
And after that we say we add what?
We add interest paid.
Interest paid. What else we less?
We less interest received.
Interest received. Then we adjust its non-cash item. So we say non-cash item include depreciation. So no one will penalize you with the format. You just put it first. We said we have loss on disposal, profit on disposal. What else? We said we amortization if it is there. And also the loss of goodwill. And then after that non-cash item is where we go to what? Working capital. Working capital activities. Go to that one. Working capital activities. As we said, we start with what? Increase or decrease in inventories. We have a receivable. We have payables. Then after that one, you get what? A cash flow from operating activities. Then we need to less our finance cost. Oh, here we should add finance cost again. There is finance cost or interest. Finance cost. So we need to less here finance cost. And also we less tax. Less tax again. So that at the end we get what? Net cash flow from operating activities. Then we go to investing activities. I can fold this one. So investing activities, they will be what? Purchase of assets. Purchase of assets, we have proceeds. We call it cash. Cash from sales of assets. Cash from sales of assets, we have what's called again dividend received. On that one, and then the last one we have now financial activity. Financial activities, we will have issue of shares, repayment of loan. We have dividend paid, and that's a format. So once you have that one, it give you a leeway on where can I start. Like the first one, we need to get the profit before tax. Have they given us the profit before tax?
Let me copy first, then we continue.
Oh, you copy the format, huh?
Changing the words to this laptop.
So have they given us the the profit before tax? Actually, they will not give you at all. So it is upon you to find it. So what will help you to get the profit? The profit is the retained earning. So you know retained earning account is what will help you to get the profit. Retained earnings account. So let me open my retained earning account. Retained earning is an income. So I have balance product. How much? In our total balance, it is under equity and liabilities. That is retained earnings. 33.
From retained earning.
Retained earning for 2017. How much?
It is 3603.
3603. That is the retained earning. Then brought forward will be carried forward. Carried forward will be, that is 56.
5697.
697. And then that is the, they paid dividend. So if there is any dividend they paid, we declared here. So let's see if there is any dividend they paid.
The first information.
The first information.
The first additional information.
The only limited profit after tax for the year ended at 1st December, or that one. So we don't include tax. So there is a profit after tax part, or we call it income statement. Just write income statement. So sometimes they hide this income statement. So that we write income statement of what? 820. So we can close this account. So we take 36 plus 2180 to give us 5783. It should be the same with this side, 5783. Then the balancing figure here is what they paid as a dividend paid. Sometimes they can either hide this dividend paid or hide the income. So if they give a new dividend, you find that the balancing figure is this one. So we less now 5697 to give us dividend of 86.
So anytime we are being supposed to, so anytime we've not been issued with profits before tax.
Yes.
You will going to use the retained earnings to
yes. So anytime you are dealing with the profit before tax, you need to use the retained earning and the dividend. And then, so you see we have the profit before tax, but this is the profit after tax, but we need the profit before tax, meaning we need to get the tax that we added back. So we need to prepare a tax account. So our tax account, I will prepare
the income, the dividend paid cannot be the profit before tax.
This one cannot be profit before tax. This is the just dividend. We will take it to the financial activities. So that one was just helping us to get the dividend we will take to the financial activities. So for tax, just check the current tax in the trail balance. Kuna current tax 2017 ya how much? 90. That is balance brought forward. Kuna current tax ya ngapi?
Current tax kuna 90 na 150.
Yes, 90 and 150. So balance carried forward is 150. Then what else do we include? Tax account. What today paid during the year?
Did they pay? The last additional information number 3.
Yes, so they say the company finance cost and income tax expense for the year was 63. So here, what they paid here, we indicate where can we indicate? Yeah, so they paid here. That is income tax, income statement. They paid ngapi? 63. 63. 53 plus 63. I think you don't see this one there. You don't have the issue. So in fact, this one is what they have just paid. So for us to get profit before tax, we will take this one to 80. I will take to 80 plus 63 to give me what? 2180 plus 63 to give me
2180 plus 63, it's 2243.
2243. 2243. Okay. The income statement payables. So we go to what else can we open in the workings? What about depreciation?
So that is the profit before tax already.
Yes.
The amount, the addition of 2180 plus 63.
Is the amount?
Is it now the figure for profit before tax?
Yes, that is a profit before tax. Then what else? Depreciation. What is the note about depreciation?
Depreciation, not number 2.
Yes.
The PPE in the books of
Depreciation.
7290. The company depreciates 10% per annum on straight line basis. The date of purchase to the date of sale.
The credit side, eh? So we should debit tax paid inafaa kuwe na debit side. They are paid even yesterday, so we debit the tax paid. The tax paid, it should be on a debit side, that is 63. So that the balancing figure here is what will goes to income statement. The total amount, because tax paid and what it goes to income statement is the total amount they should have paid, but this one is actually what they paid. That's why we are finding the cash. So you will check, because this one we need to credit a bank account or cash account. So that's why we will not again credit here, because we need to observe that the entry. We debit this one, we credit the bank or cash account. So it will be 150 plus 63 to give us the balancing figure of what? 213. 213. So again here should be 213. So the balancing figure here should be
123.
123, yes. Okay. Okay, so we are done with that one. So actually this one again will change. That is plus 123, 180 plus 123 to give us a total of 2303. That is the profit before tax. So we can put it here. That is 2303. We don't have interest. We don't have interest receipts, all that. What about depreciation? So the PPE will help us to get depreciation. So let's open a PPE account. If we open a PPE account, that one will guide you if you have any depreciation. So just read for me that note and tell me what is where what how can we compute or how to record such a scenario. The best thing is to understand these principles. Yes, not number one. I think it is not number one.
Number two.
Number two. Yes, number two. Say the property, plant, and equipment in the books of Bwani Limited as 1st January 2018 had been acquired at the cost of 72,90,000. The company's depreciation is to be depreciated all assets at the rate of 10% per annum on cost. On 1st September 2018, Bwani Limited sold an item of plant with the net book value at the date of sales is 520,000, and this item of plant had originally cost 800,000, and the company made a loss of 20,000 on the sales of the item plant. So here we will have the balance brought down. Yesterday we opened the PPE account using cost.
Yesterday.
Yes, there were 2 years, 2018 and 2017. No. It means that inatumia nini? Those figures are net book value, not cost. They are net book value. Ikikupea one financial year like 2018 alone, that is cost. But ikikupea 2 different years, that is the net book value. So you know normally that you know the balancing figure in the balance sheet is the net book value. We have already less the accumulated depreciation. So I take 910 here, and the balance carried out for 2018 is what? 70, 76, 5910, yes. The property PPE, 5910. The other one is 7680.
From the balance.
Yes.
Okay.
No, we are not recording any cost. That's why I told you they have given us 2 years. That one we are recording at the net book value. So again, disposed asset, we need to capture it using the net book value, not cost. Disposal. Okay. So to dispose an asset costing 520. And then, so what else did we do? We didn't purchase. So you can now just close this one. Revaluation, check the revaluation. Is there any revaluation? Reject a revaluation if there's a revaluation gained. Revaluation 2017 we had 120 and 2018 120, so there is no revaluation there. 120, 120. There's no revaluation. So automatically we can close up this account. 7680 plus 52 to give us 8200. 8200. So again, this side should be 8200. And the balancing figure is acquisition.
So we are not going to do anything with the original cost of the item and the loss of 20,000.
The loss on?
What are the figures? Are we not going to deal with them? The original cost of the item, that is 800,000.
You are speaking with a low tone. I'm not getting you.
I'm saying.
Yes.
the original cost of the item was 800,000.
Yes, that's why
the company,
these PPE like 510 is a net book value, not cost, right?
yes.
Again, 7680 is a net book value. It is not cost.
Yes.
So we are not going to use what the cost, because the item itself is on a net book value. Look at the scenario the yesterday question. Tulikuwa tumepewa the cost and accumulated depreciation, ndio? Ukidecide kutumia cost, yeah, just use the cost, but ukitumia cost, disposal hapa ingekuwa tungetumia cost but hatujapewa the balance carried down for the cost, so we could have taken 7290, then we disposed could have been 8,000, right? So if you have decided to use cost, just dispose up to the end, but if it is the net book value, you use the net book value. Even you can redo the next, you can't redo the yesterday question, opened the PPE using the net book value. Yesterday we did it using the cost, so you can't do it using the net book value. You will get the same figures. Okay, so acquisition here is how much? I will take 82 minus to 110 to 910 to give me 2290. Then we open a provision for depreciation. Provision for depreciation. So provision for depreciation, we have balance brought down. Ilikuwa ngapi? Tumeambiwa the cost, this company at the PPE which cost us 7290 on 1st January 2019, and all asset is to be depreciated on at the rate of 10% on the what, a pro rata basis, or the date when you purchase or you sell an asset. Meanwhile, the accumulated depreciation product here will be 7290. We take that 10% times 10% to give us that one is 729. That is the accumulated depreciation. And then we have depreciation carried down, balance carried down. Do you have balance carried down?
For provision for depreciation.
Yes. Do you have balance carried down? Provision for depreciation. Provision for depreciation. First, there is an asset we dispose, right?
Yes.
So kuna accumulated for asset sold. So to get depreciation for asset sold, the cost ilikuwa 800, ndio? Now I dispose na 520. Meanwhile, depreciation itakuwa the different. That is 280. And then what else do we have? So we don't have, they have not given us depreciation charge for the year, and they have not given us the balance carried down. So the balancing figure here will be the balance carried down. So you take that 729. I will take 729 minus 280 to give me 489. That is the balance carried out. So meanwhile, we don't have the depreciation charge for the year. So hapa itakuwa blank. So this one itakuwa blank. We don't have that one. The next thing we go to disposal account. Ungepata hiyo part kweli?
Hiyo especially hiyo tafuta the provision for depreciation. Hiyo revise sana.
Disposal account. But this thing, it is not hard. It is, are you understanding the principles? Like here we dispose, you say, I dispose an asset which cost how much? So I said, yeah, cost of an asset. I dispose an asset costing 8,000, 800,000. Do I have the proceed for this asset? No, but they have given us the loss. So I write the loss. Loss on disposal. How much? 20. This asset I have disposed, I credit depreciation, provision for depreciation, I debit accumulated depreciation. Meanwhile, I have to credit disposal account. So here I will say accumulated depreciation. For me to get that accumulated depreciation is 280. So I can now balance this one 800. Again, this one should be 800. So the balancing figure here is what? Cash proceeds. Of how much? It's easily 300, 500. So there's a cash proceed of 500. So you go straight away and put that answer. You don't need even to again wait. That is cash from selling of an asset. That is 500. Tumepata acquisition equal ngapi? Purchase of an asset 2290. Kuna work nyingine kweli? Tax paid, tunaweza weka tax paid yenye tumeiwork, that is 63. Kuna kitu kwa working tumengine tumefanya, kuna dividend paid, naweka dividend paid 86. So from our working, I don't think there's anything we have left. That now we can go, now we pick from the trial. Oh, there is a loss on disposal again, that is 20. Then we go back to our question, we check other items. So we said we have loss on disposal, profit on disposal. What else do we have? They have given us finance cost. How much is the finance cost?
From the trial balance.
Additional information. There's a finance cost
48.
48. Yes. And then you come to increase or decrease in inventory. 2017 year inventory ilikuwa how much?
It was 1830.
1830. 1830. Then we less the current, that is 2070. So it was an increase, meaning you purchase, it was cash outflow ya ngapi? 240. So we less that one. There was a cash outflow ya 240. Debt receivable, how much is the receivable? Tulisema receivable iki increase, hiyo ni cash outflow. That is, we add a 1020 minus
1170.
So there was an increase of how much?
Of 150.
150. An increase of 150. Payables?
Payables 2250.
2250. Less?
2208.
No, the first one, I think payable, that is low. At 2208. So it is a decrease. So if it is a decrease in payable, meaning you are paid supplier, it is cash outflow. How much?
42.
42, yes. Cash outflow, 42. Then, so you add it from this one should be on this side. That is 2303. So you add all of this, you get the cash flow from operating activities in Ngapi? That's hard for me.
And up to the end.
No, up to just cash flow from operating activities.
Or 2303. Then 48. 22. Have 1939.
1939, no?
Yes.
1939, let me drag it, I see. Yes, 1939. So here we get 1939. It is a positive figure. Then we said once you add finance cost up there, you need to less again your finance cost. So we less that finance cost of 48. So now again we need to less this tax of 63. That is tax paid. So when you say now 1939 minus 48 minus 63, how much are you getting?
1828.
That is 1828, huh?
Yes.
1828. And then we come to investing activities. This was just working, it was investment. So we less, because this one is purchases, we less, huh? Then dividend received. Do we really have the dividend received? No. So when you add this one, these two alone, so this one we should take it here. It should not be here. This one we should bring it here. When you add these two, how much are you getting? You bring it here.
That is 2290 plus 500. That is 1790. 1790.
And then the issue of shares. So you check the ordinary share. At the beginning of the year, tulikuwa na ngapi?
Ordinary shares.
Yes.
Share capital. No?
Yes, it is under share capital. That is, we get 300, and there is another 360. So we'll issue shares. So ukiissue shares, we'll receive cash. So to receive cash ya ngapi? See? 60. Then there is another one, issue of premium. Issue of share premium.
75.
So at the beginning, we have 75 minus 150. How much cash did we receive?
150.
No. See, 150 minus 75.
75.
75 again. Dividend is payment, so we need to less this dividend. It is from working. So how much are you getting? If you add this 3, you bring it here.
62 minus 86 plus 95. 49.
Yes?
49.
Is it 49?
Yeah. 60 plus 75 plus 86. Yeah. 49.
See? What about there is another? Check the loan. Loan we have it, but yes, we have repayment of loan. We have 2400 at the beginning, then at the end to reduce back and pay 25, 50 to give us how much is that?
24. 150.
So we repaid our loan 150. That is cash outflow. Now you can add for me and give me the total for financing activities or financial activities.
$199.
199.
Yes. Oh, that one is negative. Oh.
Yes, it is negative.
60 minus 86 minus 5 negative 101.
Negative 101. 101. So if you add the 3, you now get what? Cash flow of the year. Cash flow for the year in Ngapi. So you add the 3, that is positive 1828 plus this one is negative.
1790 is positive. Huh?
It is negative. See, 22 was negative plus 500, we remain with negative 1790. How much?
Negative 63.
Negative 63. 63. And then we say here, cash